freedom isn't the result of wealth, it's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey here with Adam Penn. Adam, how you doing today?
Great. I'm doing great. Excited to talk about some predictions for 2025.
I know. This is, what can go wrong when you're trying to predict the future, right? No one's ever made mistakes doing that. But no, I thought this would make for interesting discussion. This article ended up in my inbox this morning, and I'd actually never heard of the group that put this together before. Turns out they own about just shy of $3 billion of real estate, most of it multifamily. So sounds like for someone to write the top 10 predictions for multifamily real estate seems like they have kind of earned the right to have an opinion. So I don't know. I thought it'd be interesting to just kind of go through this, and we can share our thoughts on some of their predictions and some things that we're seeing and whether or not we agree or disagree. So I don't know. Let's dive into it.
Let's dive in.
Yeah. So first one here, this might be a fairly not spicy take. Multifamily rental markets will return to positive year-over-year rent growth. So I tend to agree with that. And I'm actually going to see if I can pull up something else, because I saw something the other day, and we'll throw all the notes from this in the release notes. Okay. I came across this yesterday, actually, which is from Jay Parsons. If you're on Twitter, you should be on Twitter. Real estate Twitter is a fun place to be. But Jay's a housing economist, always posts some really good stuff. And he posted this, which I think was a piece from CBRE, saying that they're really expecting by the end of 2025, every major market to be back in positive rent growth, except for Austin and Salt Lake City, which I think is interesting. We can blow up the image here, but I think that this is a fairly non-controversial take, simply from a supply and demand point of view. I think that this is, again, a fairly uncontroversial take. I think just from the fact that there's no more new supply coming online, probably going to see this across the board. They've got a chart here. It's kind of interesting, just looking at this. I don't know whose data this is from. Might just be their own, or Multilytics. Oh, that they have their own. That's good. I'm looking at one of the markets here. They're projecting 4.6% year-over-year rent growth in Las Vegas. So that's good. Also, interestingly enough, their data here, this proprietary model, kind of confirms our thesis. I think looks like Orlando and Jacksonville. Some of the Florida markets might be larger, but they come with some different implications to them. So that's cool.
Especially difference on the insurance side of things.
Exactly. Yeah, the expenses are for sure to be higher. But no, that's good. So that's it's always nice to see things see independent sources kind of validating your thesis. So I definitely agree with this. I think just this is a supply and demand story. The supply is slowing down and demand's not, and so that's naturally going to lead to falling vacancy and increasing rents. See what else I got here. Ooh, interest rates. Interest rates will hover between 3.75% and 4.75%. Okay, Adam, what's your interest rate crystal ball say?
Yeah, I mean, I have a hard time believing that we're going to be down into the threes again, especially on the residential side, which might be a little more important to some of our listeners when they think interest rates. Right, they're probably more thinking about what they can buy a home for than what they can get a commercial loan on a $10 million multifamily building. Because where they're actually, inverted to what they normally are right now. You've got commercial multifamily and just commercial loans in general are about 1% lower than we're seeing residential coming at. Residential right now is at high sixes, mid sixes, and we've seen some commercial loans get locked in the mid fives recently. So I don't know, especially with there was a Wall Street Journal article that said treasuries are going to go to 6%. I don't know if I believe that, but yeah, I don't see them. I don't see the 10-year treasury coming down into the threes, right?
Yeah, I completely agree. I think that was another thing I was going to mention. That was a recent, I think it was from the He's the head of fixed income at T. Rowe Price, came out with some research saying they think the 10 years going to 6% in 2025. And I think that it's a bold call. I don't know that they necessarily know that I agree with some of their assumptions into it. I think they're, we won't fully get into that. But the main point that the guys here were making was that they really don't think that the Fed's going to cut really a lot more into 2025. And I tend to fall in that camp as well. I don't think we're going to see
Fed cuts will lower the yield on loans, right? I mean, we might see the Fed rate lower, but I don't think that's going to lead to lowering interest rates for borrowers on mortgages.
Yeah, and that's been the interesting thing over the end of 2024 was, the Fed cut and the 10-year went up, and you got all the loans and other products that are indexed to the 10-year, and so of course those went up. I think 30-year mortgages have come back down, but that was the weird thing, seeing them they'd gotten down in the low 6s and then shot back up above 7 after the Fed cut rates. It's so hard to make an exact prediction on this, but I tend to agree kind of with the idea here. I think 3.75 might be a little low, but I think we're gonna. I don't see us having these massive cuts. I think people who are still sitting around waiting they're saying, well, I'm just going to wait for interest rates to drop. I don't know that that's going to happen unless there's the wheels completely fall off the economy, and at that point we've got a whole lot of other concerns. So I think we're probably. I like to think that we've normalized. And we're probably we're back to the era of new normal rates. I don't really see them going up massively, but I also don't see them going down significantly from here.
Historically, this is not a horrible average to be at.
Yeah, exactly. We both know a lot of people who have made a whole lot of money over the years at higher interest rates than we currently have. So I think we've said this before, that more so than the rate, it's just the stability has
the rate of change, right? Going from 8 to 4 is a lot different than going from 1 to 4.
Exactly. And even if it is 8 and that's the new normal, if it stays there and everyone can make decisions and base their financial planning around 8%, then deals will still get done. Not to say that there won't be chaos in the short term, but it's more important to have stability than it is necessarily a low rate. All right, the third one, realized losses in all real estate loans will accelerate over 2024. Interesting. Okay, and they're saying that the extend and pretend is coming to an end. I tend to agree with this. I think we'll see more of it. Although I think that to the extent that extend and pretend can continue, I think it's going to. You got a lot of folks, especially the lenders, just do not want to actually realize those losses. I think the percentage will tick up, but I still don't think we're going to see some massive wave of foreclosures and it's going to be fire sales and everyone like this doomsday scenario that everyone keeps waiting to back up the truck to buy at pennies on the dollar. I don't think
that's happening.
No. Yeah, I definitely think we'll still see delinquency tick up, but that is a separate thing from, again, the doomsday scenario, right? Like you can have an increase in foreclosures, an increase in realized losses without having this massive chaos.
The next one here is interesting because, I mean, we are starting to do some of this, right? Debt funds will continue to be a major source of real estate financing, right? But primarily because there's a lot of fixed rate good loans out there. The one before this was that delinquencies will shoot up, but I know someone right now who's assuming a large HUD loan in the low 2s. And so if you're able to do that and you want higher LTV, you need some type of mid-level debt to accompany that, right? If you're at I think theirs is roughly 40 or 55% LTV. If you're at a 55% LTV and you want to be at 70, you might need some mezz debt.
Yeah, and or to fund construction or to fund other parts of the deal, right? I mean, we've certainly seen this has been a huge trend the last couple of years. Are the private debt funds really stepping in and filling that? And I agree. I mean, we've got our private credit fund that's focused exactly on this, right? It's this exact thing to fill that mezz debt or pref equity kind of portion of the capital stack to help some deals get done. Whereas we're still somewhat tight on credit from the first position notes. I think, Adam, to your point, you get some good rates on some assumptions, but even agency debt that's being originated now at fairly attractive rates, it's still 60, 65 LTV if you're good, and that's for like quality projects. And that's what we've been quoted on some of the projects we've offered on. So if you, again, depending on the CapEx needs and really the business plan, if the rest of the capital stack for the project can't be equity, really debt funds are where everyone's turning. So I definitely agree with this. I think it's going to continue to be a source, and I think we've positioned ourselves through the credit fund to capitalize on this, right? And to be able to provide a cash flowing investment to investors to be able to.
Although ours looks small at 50 million versus the 12 billion that BlackRock did there at the bottom line, but yeah.
Yeah, for sure. We're it's a drop.
Their number's smaller, but they've got a few extra zeros.
Yeah,
so 12 and ours is 50. But anyway,
that's exactly right. But it's the same idea, right? And I think that's the cool thing is like this is obviously some form of institutional validation. What's that?
It's a larger trend that you're seeing larger institutions move towards.
Absolutely, and here we've found a way to be able to bring the benefits, not on the borrower side, but on the lender side, to be able to bring that to our investors to be able to get some cash flow. And so, not to beat a dead horse pitching that deal, but we're excited about the credit fund, and it's a direct play on this trend right here. All right, well, we got at number 5. The spread between home ownership and renting will moderate, but stay around current levels. Okay, I generally would agree with that. I think the spread, obviously, I mean, this chart here is, we've seen variations of this chart for a while, and it's massive, right?
The part of this that I find interesting is kind of, around a little bit of our investment thesis of where we look, right? We look in markets that tend to have a larger divide between the rental price and the home purchase price. I mean, an extreme one would be, and this isn't where we look, but an extreme example of this would be the Bay Area, right? I mean, it's drastically cheaper to rent a building than it is to buy one. Just because the pure cost of the building is so high, everyone's betting on appreciation when they buy. And so even if we saw this tighten, I think the markets that we look in and invest in wouldn't be as affected because we begin with a much larger divide. For sure.
And that's something that, if you're asking yourself, well, why does this matter? There's a balance between wanting to provide society as a whole being able to afford a home, but then us as real estate investors wanting to have demand for the product that we're offering. And so, the unfortunate reality is that when homes are more unaffordable, that obviously drives rental demand. I definitely agree with this. I mean, I think the run up in both prices and what we've seen from interest rates, that's what's really driven the affordability issue here. And so I think that with this spread being large, that will continue to favor owning rental real estate. And will continue, again, as we've talked about, I feel like ad nauseum now, it coupled with a lack of new supply in specifically multifamily, this trend continues to drive rents higher. Oh, deal flow. Multifamily sales activity will tick up, but stay low relative to the 21-22 peak. Well, that's...
21-22 peak was essentially a bunch of people retrading back to each other every time that the new group of passive investors wanted to invest, right? I mean, it's sad to say, but that's kind of what happened in a lot of those mastermind groups and different things where people would come in and they would have a whole new group of investors. They'd buy it from someone else in their group that had just doubled their money in 12 months. I mean, I think that's a big reason why we saw so much. And once again, back to the argument with interest rates going down and buildings being a cash flow driven investment, we had high rental rates or high growth in rents driving NOI up, and then paired with low debt, there was just more things transacting. People were able to overpay for what that previous owner had no reason to say no to.
Yep. You're spot on about something that I don't think is very widely talked about, but there were several masterminds that we are familiar with and know people who are part of, where that was basically the entire MO, right? And when you had continually compressing cap rates, you could do this. You could have a group that buys it, and then 6 months, even 9 months, a year later, a separate group from within the same mastermind now buys it at a higher price. And when we had this really weird market where that worked for a while, and you saw a lot of people doing that. So I agree.
Did was change the front sign, and then the price went up.
Exactly. Yeah, we call it the whatever, some sort of terrible name, but that was there. There was a whole lot of that, and I think that's the big thing. This spike right here. I mean, that obviously, transaction activity been trending up coming out of the GFC, but this was just insane. This is again a fairly mild opinion here that I agree that we will see sales activity tick up. I think you and I have been seeing that, right? We've seen more deals. It's kind of slowed down. I think the election put a little bit of a damper on it, but coming out of that and then coming out of the first of the year, all signs point to increased sales activity, but we're not going to see anything close to that 2021 amount anytime soon. Construction costs will be impacted by tariffs. Well, I have some thoughts on this.
Go ahead.
I kind of want to fully read what they think here. Said that he's saying that they believe will have a generally inflationary effect on the cost of construction materials. So I agree with that, but I also don't. He says this won't seriously dent cost, at least in the short term, but will provide an additional challenge to ongoing projects and construction starts. Okay, that's fine. I think say that they will be impacted. The question, obviously, if there are tariffs that impacts price, then the question is, well, what's the impact of or how severe are those impacts? What's the degree to which they're impacted? And I saw some research a couple weeks ago that kind of broke down. China is obviously the one that's directly within the president-elect's eyes, and that's where most of his focus is going. Although there's been some focus recently on Canada, but China gets the brunt of the attention, and you look at how much from a construction materials standpoint, how much comes from China, and it's not a whole lot. So I do agree with this that maybe there will be impacts, but it's not going to be massive. I think if you've got folks that are projecting that there's going to be this incredible rise in construction costs, I don't think that's likely. There have been some discussions about tariffs on Canada, and a flat tariff there. We get a lot of timber and wood from Canada, and I think that could be another story. But I also think a lot of the discussion that's going on right now with Canada is more of a bargaining chip than an actual intent to place tariffs. So we'll see. But generally, just based on what I've been seeing, I fall in the camp that this is not, yes, there will be impacts, but I think they're going to be very, very moderate and probably not any more than just typical levels of inflation.
I'm not even sure this author is horribly convinced of this, because the chart there, although it does go pretty flat and to the right, is of new permits for privately owned housing. So it doesn't exactly correlate to the cost of construction, especially because it's not moving in one way or another. I guess it's down a little bit, but that's all prior to those.
Those tariffs. Exactly. We can't make an argument that downward move in permits was due to the threat of tariffs or tariffs being implemented, for sure. Man, covering a lot of ground in this one. Number 8, property insurance will normalize to an inflationary growth rate. I tend to agree with this. We've had in insurance terminology, it's been a hard market for the last few years, which means that premiums are increasing. And that's been great if you're in the insurance business, and it's been really tough for everybody else. And I think anyone here that has had any exposure to real estate's probably seen this, right? I mean, even outside of rental real estate, if you own a home, I personally have seen, my own house insurances or homeowners insurance has gone up significantly over the last couple of years. And of course, we've been seeing this in some markets. Some markets are impacted more than others on this, but I tend to agree with this take that I think a lot of inflation and then a lot of potential, some natural disaster things. I think we've seen probably the biggest impacts, the growth from that is probably in the rear view. Not to say that it's going to stop or that it's going to go down, but I don't think we're going to continue, especially in some of these Florida markets that have seen just absolutely insane increases in insurance. I don't think that's a trend that's likely to continue. I don't know. Adam, you have any thoughts on insurance?
I'd like it to be cheaper, but I don't see it going cheaper. Yeah, normalized to inflation. The next one's interesting. Affordability will become an increasing issue, and he goes in a little bit here to talk about. He's got the most interesting stat in there that I see is the median first-time home buyer age is 38. And the median buyer age being 56, and then second-time buyer being 61. Really, he's going on and saying that this leads to our original thesis that rents are going to continue to go up. People aren't able to afford. Younger professionals are forming households, but they're not able to afford newer properties. Right? They're not able to come in and buy a primary residence, so they end up being renters, which continues to increase the demand side of renting.
Yeah. And that's, he talks about that exact thing here. As rents start to pick up, that will unwind, exacerbating the lack of supply with significant multifamily supply not expected to hit the market until 2027. Not a lot can change the situation until housing prices decline. But this is unlikely unless something like a recession occurs. So certainly seems to be, again, this is further confirmation of, I think, or further agreement of the thesis that that we have around multifamily and why we're setting up. I think 2025 is definitely going to be a year for acquisition, for trying to get in place of these trends, because once this hits and we start seeing the rental increases, the prices, again, barring some kind of recession or some other larger systemic issue, once the rent growth takes off, the opportunity is gone. All right, last one, opportunity zones. It's amazing. I actually had a conversation with an investor, a very experienced investor and business owner last week, who had never heard of this, never heard of opportunity zones, did not know it was a thing, and was here at the very end of the year, was like, well, I've got a lot of capital gains this year. And I was like, well, you could might look into opportunity zones, and looked at me like, what is that? So it's amazing that this has been in law for, I guess it was part of the 2017 tax bill, and it's supposed to be phasing out, but it's amazing that it's been out for as long as it is, or as long as it has been. And there's still so few people, even like people who are otherwise deeply involved in real estate, don't know anything about it. And for a quick overview, if you find yourself not familiar with it, it was something that was passed under the 2017 the Tax Cuts and Jobs Act. That basically allows you to defer capital gains for, I think, up to 10 years, and then they eventually roll off, or you can further defer them. So there's a really, really great program. If you're buying property, again, it has to be qualified property within a certain census tract that's been designated as a opportunity zone. But really, really great way to save on taxes. If you can find some projects that go there. I know some folks that have put together syndications, and then they're able to pass those same tax benefits on to their passive investors. Unfortunately, this was one of the things that was going to roll off, and I agree with this. I think we're going to see an extension of it. It seems like we're just in maybe 2024 starting to see a serious uptake in this. I saw more projects marketed as opportunity zone projects this year than I think I had the previous 5.
Yeah.
So definitely think I agree that this will be extended. And I certainly hope it is, and I hope that it's a way, because it's good for everyone, right? It's good for us as investors to be able to save on the tax. But I think you have some of these census tracts that could really use some help, and it's a great way to get some investor dollars in some areas of the country that might not otherwise see a lot of investment. So I think it's really good all around. I don't know, Adam, any opportunity zone thoughts?
No other thoughts for me. I think this is an interesting article to review.
Yeah, for sure. I think this is great. We'll see, obviously, right? No one knows. None of us truly have a crystal ball, so we'll have to see what actually ends up playing out the rest of the year. But I think a lot of these are spot on. I think that's all we got for this episode. I don't know, Adam, any other thoughts? Parting thoughts? I'm
excited for everyone to listen along. And as always, if you guys have questions, feel free to reach out to us. Our contact information's in the release notes. Absolutely. In the release notes on the website, we got a contact form. You can figure out how to connect with us on social. Again, it's wealthindependencepod.com. You can get in contact with us. We'd love to hear your feedback, love to hear your thoughts. All right. Thanks everyone for tuning in here at the Wealth Independence Podcast, where freedom leads and real wealth follows. And we'll catch you on the next episode. Thanks everybody.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.